Can you all hear me?
Yes, sir.
Right. So thank you once again for coming online for the third session on markets. For the last couple of weeks, we've gone to foreign exchange and we covered several aspects like the bid on offer, how to calculate exchange rates, cross rates. Then if it's the same kind, indirect, what to do, if there are different kinds, what to do, etc. Right? So any questions from the last couple of weeks before we get started? Anything you would like to get clarified? Any clarifications that you may require? Yeah. Nothing? Good. Right. Then we did purchasing power parity. Remember? And I believe the next area is arbitrage. Did I explain arbitrage last week? Hello? I did not, no? I couldn't hear you. Hello?
No, sir.
I did not, okay. Right, I'll explain using a simple example. Right, you take the price of a mango in two different cities. Let's say the price of a mango in Gaul is 10 rupees. The price of a mango in Colombo is 100. Yeah. So if the same kind of mango, same taste, same size, same weight, everything is the same. They are priced in there are two different prices in two different cities. What can you do? You are very smart. What might you do? Yeah. What do you all think? Using these two prices, what can you do?
Buy from Gold and sell in Colombo.
Exactly. You can buy mangoes from Gaul and you can sell it in Colombo. Right? Then you make a 90 rupee profit without taking any risk. Isn't it? So if you can do that, no risk, profit, that's called arbitrage. Why? Because you're using the mispricing of the same product in two different markets. Right? The same product is priced in two different ways in different markets. So you can buy from the cheaper market and sell it in the more expensive market. Buy from the underpriced market and you sell it in the overpriced market. Make arbitrage profits. What happens if you do the opposite? You buy from Colombo and then you sell in Gaul.
We'll be losing money.
Yes, that is called charity. Right? You buy from Colombo, sell in Gaul, called charity. Okay. Now, this disparity might not last for long. Might be a temporary thing. right? Maybe a short-term phenomena which will not last eternally. Because if it's there eternally, then everyone will buy from gold, all will dump in Colombo. So it might not last for long. And while it lasts, it might look like a honeymoon. You can enjoy. So why will this honeymoon not last for long? What do you all think? Why? For what reasons?
Everyone will start to do that, and then naturally the price will go down.
Which price will go down? If both start going down, if Colombo goes to 95, gold drops to 5, still you can maintain the profit. Yes, your answer is correct.
Otherwise, on the other hand, gold price will go up.
Yeah, that's also correct. Yes, because everyone will buy from gold. No? So the demand for mangoes in gold will increase. No? When the demand goes up, the price will also. Yeah, when the demand, exactly. When the demand goes up, the price will also go up. And everyone will start dumping in Colombo. Right? So everyone sells in Colombo. The price of a mango in Colombo will
Go down.
go down. Right? So the price of a mango in gold going up, the price of a mango in Colombo goes down, and eventually these two will converge. Right? They will meet in between, then no more arbitrage. Yeah? So for that reason, the price disparity will reduce. So based on market forces, arbitrage may not last long. What else? Okay. For what other reasons will arbitrage not last long? Anything else? Simple reasons, nothing technical. There is no magic, only logic. Yeah. Then what about transport cost? Logistics, storage, and all that. You'll have to buy mangoes from Gaul. You'll have to transport them to Colombo. On the way, there'll be some wastage, isn't it? So there'll be transaction costs. What else? What are the reasons? Yeah. What about taxes? Taxes. For these reasons, arbitrage may not last long. But if you have arbitrage, then yes, you can make use of it. Clear? Any questions? So arbitrage is a simultaneous purchase and sale of an asset in order to profit from difference in the price. It is a trade that profits by exploiting price differences of identical or similar financial instruments on different markets or in different forms. Arbitrage exists as a result of market inefficiencies. Okay, so that's a key word. It's there because of market inefficiencies. It provides a mechanism to ensure prices do not deviate substantially from fair value for long periods of time, right? Because fair value, let's say, of a mango, you feel the mango should be average worth only 50 rupees. So if it falls below the average value, then you feel like buying it. And if it's above, then you don't feel like buying. No, you feel like selling. Okay, so for as long as the price is undervalued or underpriced, you keep buying. Overvalued, you keep selling. Simple logic. And so that's why people tend to go for offers like credit card offers and all that. For this reason, whenever prices are underpriced, market is undervalued, a lot of buying emerge.
Marketing inefficiency means undervalue and overvalue the market.
Yeah, well, not only that, right? Some of these factors that we discussed also contribute to inefficiencies. When the transaction cost is very high, that means the market is inefficient. You don't feel like doing a transaction in the market, isn't it? Now, let's say, for example, the stock market, there are no transaction costs at all. Right? Then more and more people will feel like trading in the stock market. But if the transaction cost is very high, let's say the transaction cost now is 1.12% or something. If it goes up to about 10%, you might not trade. But if it's cut down further, then you feel like trading. And so transaction cost is also a factor that contributes to market inefficiency. Taxes also cause market inefficiency. Then sometimes information might not be symmetric. Everyone might not have the same information. Information asymmetry also contributes to market inefficiencies. Yeah, it's a good question. Anything else you need to clarify? Yeah, so given the advancement in technology, it has become extremely difficult to profit from mispricing in the market, right? Because markets become more and more efficient when you introduce more technology. Information tends to flow faster, right? And market participants tend to react faster. Now, very interestingly, sometime back I read an article that in some of the major stock exchanges, right, the traders tend to purchase apartments in and around the exchange. Okay, so if there is an apartment in the adjoining building, the price might be very high because everyone wants to stay there. Why? The split second. Now, see, data flows through cables, fiber optics, and all that. No, you know better than me, right? So some cases, if you stay far away, there might be a small millisecond difference in the data speed that it comes to you. And it might reach a person that is closer to the epicenter than a person who lives very far. Right? Because some of these trades nowadays happen through technology. There is very little human intervention. Only the human intervention might come in terms of deciding whether to buy or sell and at what price levels, right? You feed everything into the machine, then it automatically does all the algorithm calculations and all that. For example, Bitcoin. So these things are done by technology, machines in most cases, computers, supercomputers, right? So these traders purchase apartments close to the stock exchange or whatever, the futures exchange or whatever. Why? Because the data flows at least a millisecond faster. And that millisecond faster, receiving it a millisecond faster, helps them make informed decisions, right? Before any other trader makes the decision. So that is crucial now. Okay, it has gone to that extent. Many traders have computerized trading systems as set to monitor fluctuations in similar financial instruments. Any inefficient pricing setups are usually acted upon quickly, and the opportunity is often eliminated in a matter of seconds. Right now, seconds now it's milliseconds. It has become milliseconds. Okay, because the information that came 1 second ago is now obsolete. Everyone, the entire market has reacted to it. If you get it 2 seconds late, you're finished, and the market has just shut up. So things have become so efficient. If you are not efficient, you probably should not be a good trader. You might not be a good trader. Speed to market is very, very important. Clear? Any questions on this? All right. So let's see whether you all can identify any arbitrage opportunities. Now, before we do this, let me do something else. Another exercise. Last week, did I not explain the pen example? You buy the clip and the pen separately? No? Did I explain or not? Because I did it for one class, I can't remember whether it was this one or the other one. Did I mention it? Oh, you all can't remember?
No.
I did not know. See, when it comes to your age, some people suffer from short-term memory loss. What you learn this week will be forgotten in 6 days. So come next Saturday, everything is forgotten. You start fresh, as if I have taught nothing. Yeah. So I hope that is not the case. Right. Okay. Example, right? Take this marker. Yeah. So let's say the price of this marker is 100 rupees. Okay. And this marker has 2 components. One is the clip, the other one is the pen. Just assume, I'm just assuming. Let's say you put the clip plus the pen is the mark. You see the marker, correct? Right or wrong? Agreed? You all agree with this? Simple logic? Yes? No? Okay. Put the clip and the pen together, you get a marker. Correct? So let's say the clip is priced at 5 and the pen is priced at 95. Okay. So if you want to buy the clip separately, you have to pay 5. If you want to buy the pen separately, you have to pay 95. And if you want to buy both together, you want to buy the marker, you have to pay 100. Makes sense? Let us say there is unlimited demand and supply of clips and pens and markers. Right? So if there is unlimited supply, now, does this seem fine? Everything is okay? But what happens all of a sudden if the price of a pen becomes 100 rupees and the price of a clip remains at 5, the price of the marker also remains at 100. Now what happens? What do you all think? you notice something like this, what will you do? Yeah. Yes, what will you do?
So buy market 100.
Nothing. You will buy? Yeah. Yes, you are right. Tell me. You will buy what? You are right. Say that once again.
So
Yeah.
buy market 100. And sell the pen
Yeah.
at 100 and again keep the same. Sell the
Very good. Very good. Right. Now, if you look at this equation, the right hand is less than the left hand. No? It's always by the lower side, by the cheaper side. You can keep buying markers. You can keep buying markers. Then what you do is you separate them, and you sell the pen separately. You sell the clip separately. So to buy the marker, you're spending $100. When you sell the pen, you get 100. Then your cost is also covered. And you sell the clip, you receive another 5. So you make a profit of 5. Right? For the same product, there is a pricing inefficiency which you can exploit and you make a 5 rupee gain. That's called what? Arbitrage. That is arbitrage. Clear? So that's how we make arbitrage profits. You buy from the lower price market and you sell in the higher price market. Make an arbitrage. Okay. Any questions?
Always arbitrage create profits.
Yeah, arbitrage means there is a pricing inefficiency. So always there is an opportunity to make profits. Right now, if this was 105, is there an arbitrage opportunity? $105, is there an arbitrage opportunity?
No.
There is no arbitrage opportunity. Right? Then if this was 110, now what do you do? What would you do now?
Instead of buying markers at once, buying clip and pen separately and sell it in the
Yeah,
market.
you keep buying clips and pens separately and you sell markers. Right? You still make a 5 rupee gain. Isn't it? Because you're spending 105 and you receive 110. You make a gain 5 rupees. Clear? And in my view, every purchase decision we make is because of an arbitrage opportunity. Everything. Right? Why do I say that? Yeah, give me a minute, 1 minute. Okay. Every purchase decision or every sales decision we make is because we see arbitrage opportunities. Right? Now, say for example, I need to buy this bottle of water. Right? I will buy it because the price is say $50. Right? So I will buy it because I need to drink water, and by drinking water, the benefit I see is more than 50. It is maybe 60, or it is 100. Yeah? But if the benefit of drinking water is only 20, let's say the whole day I have been drinking water, no need to drink water, the benefit I see is only 20. Will I buy this bottle of water? Will I buy it for 50? What do you think? Will I buy it for 50? Yeah. I might not. I will not. Then why do you think your customers come and ask for loans? They come and ask for housing loans, maybe overdrafts. So let's say the overdraft rate is 10%. Why would your customer come and ask for a loan? You quote 10%, and why would he agree to borrow at 10%?
Because he can't afford to have the balance.
He can't afford to have the balance. Mean?
In a sense, now he can't finance the full cost of the house, maybe.
Yes, yes. Yeah, okay. So housing loan, right? So let's say you're quoting 7%, and this guy agrees, right? Why do you think he agreed? Because for your customer, your client, he sees an arbitrage opportunity. Why? By borrowing at 7%, right? He borrows at 7%. The benefit he derives from the house, from putting up the house, for him is more than 7%. Might be 10%. Right? So he sees an arbitrage opportunity there. The customer might not realize it, but that's what he sees. Even your corporate clients, they come and ask for overdrafts. For 10%, he agrees. Why? Because the benefit he derives is 15% or 20%. But by any chance, you quote 10%, your lending rate is 10%, and the customer sees only a benefit of 5%, will he agree? Then will he agree?
No, he will not.
He will not agree. Right? So let's just assume the return your customers make is 15%. Right? So when your loan rate is 10%, he is happy to borrow. He's happy to borrow. Right? And his return, let's say his return is fixed at 15%. This is the return. Then the cost, is at 10%. And for as long as the cost is below the return, he will borrow or not? Will he borrow it or not? When the cost is below the return, he will
Borrow.
borrow, right? But then if the cost goes up, some, let's say, interest rate hikes or whatever, for some reason the cost goes above the return, then what happens? Yeah?
Customer tend to deposit money.
He will settle, no? You're right.
Yeah, he will settle, yes.
Yes, he will settle. Okay. That is one option. He will settle. Or he might default. He might even default. Normally, in your opinion, default rates will increase if interest rates go up or if interest rates go down. Oh, sorry, I'll rephrase it. In your experience, default rates usually increase when interest rates are going up or when interest rates are going down. Yeah,
Rates go up.
rates go up, exactly. Right, because when rates go up, let's say the cost goes to 20%, and his return is fixed at 15%, it's perhaps better for him to default, isn't it? Right. So that is why your customers might default on their loans, because the cost is 20%, but the return he gets is only 15%. Yeah. So for your customer, he can either settle the loan or he can even default. If he defaults, he will save the 5%. Understood? Agreed or disagreed? We agreed at the beginning that we will not agree to disagree. We agree to disagree. What do you think? Yeah. Right. So that is on the purchase side. Now, what about the selling side? Now, just assume that this is a car. This is your car. Right. Why will you decide to sell your car? Yeah. For the same reason, because you feel there is arbitrage, right? And you feel the price of your car is overvalued. So it's best if you sell it, right? The price is high, you can sell it. Arbitrage, you see an arbitrage. Now, for example, let's say your car is worth 5 million. Yeah. And if the price goes up maybe to 10 million. Or if someone asks it for 10 million, then you will sell it straight away, isn't it? But if someone asks it for 1 million, someone wants it for 1 million, you will not sell. Why? Because in your view, it's worth 5 million. So if there is a bid at 10 million, you will definitely sell. But if someone asks for it for 1 million, you will not sell. That's because you see arbitrage, an arbitrage opportunity. You might not realize it, but that's what's going through your mind. Okay. So in my view, every decision we make, everything, is because of arbitrage. Subconsciously, we think of arbitrage. Every decision, including getting married or getting divorced. Same thing, arbitrage. Isn't it? Sometimes we have seen borrowers defaulting, right? Can be for two reasons. One reason is the cost is going above the return, right? If the cost goes above the return, there is no point settling your loan. It's always good to default. The second thing is, at the time of borrowing, your customer may have made a mistake. Right? You would have thought his return is going to be 15%. But after some time, he realizes that his return is actually 5%. He might not realize, but this might be the actual case. Again, subconscious. If the actual return is 5%, he had borrowed at 10%, then he will default again. And again, arbitrage. What do you think? You all agree or disagree? So, any questions?
Sir, return is not only the reason for defaulting. There may be other
okay.
reasons.
Other reasons?
Yeah.
Like what?
Macroeconomic reasons.
Yes. So, my point is, whatever the reason, a customer will default because at that point, default is the best option. Well, the end result might be you might send the fellow to jail. He might end up in jail. But at that point of time, spending time in jail for a customer might be the better option than settling the loan. This is something that goes into his mind subconsciously. He might not realize it. Deep down inside, he might want to settle. But he's not settling. Why? If he settles, there is no chance he's going to survive. Isn't it? That's the opportunity cost. So the best option at that point is to default. Could be for various reasons, maybe economic reasons, maybe personal reasons. But at that point of time, he sees the arbitrage opportunity in defaulting. That is my point of view. So, Sampath, what do you think? You agree or disagree with that? There could be various reasons. But whatever the reason, the end result whether to default or not to default is because of the arbitrage opportunity. The option of defaulting to him is worth a lot more than the option of settling. Right? But your customer will not know that it's arbitrage. But actually, that is what is working in his mind. He doesn't know. He has no way of settling for some reason, might be an economic reason. What do you think? Yeah. Okay. The only thing is, don't go to your office and insist that your customers are defaulting because of arbitrage. Nobody will understand. For as long as you all understand or you all agree, you may disagree. That is also okay. Then it's fine. Okay. Now, the best example I can quote is, why are you all taking this course? Why are you all studying? Because the amount of time and money that you spend, you feel can be recovered and you can even make a profit in the future. Okay. So by going through this course, by doing this course, the cost of this course, it might be the tuition fees, the time and all that, for you, in your view, is more than the cost is less than the benefit you might derive at some point of time. So if the cost, let's just put ballpark figure, is 50. Now the cost, let's say, is 50. You might see a future benefit of 100. So there is arbitrage. Otherwise, you will not do it. But if you see a benefit only of 20 in the future and the cost is 50, you will not do it. Okay? Every decision you make is because of arbitrage, in my view. And if you make a mistake, that is because you got the arbitrage wrong. You thought the cost was less, but the cost is more than you expected. Okay. Any questions? Right. So let's see whether you all can identify arbitrage opportunities in this code. We have $N quoted by 4 different banks. Can you identify arbitrage opportunities? can you identify arbitrage opportunities? Yes. Yeah. Arbitrage, do you all see? Hello.
Buy from HSBC and sell at BNP.
Okay. Very good. Very good. Yeah, I know what you meant, but very important that you be very specific. Right? Buy from HSBC, sell BNP. And there are two things, no? Two currencies, isn't it? You have dollars and yen. So what do you buy from HSBC and what do you sell to BNP? You need to be very, very specific. Not only in answering these questions, but when you do other things also, like if you are doing a board paper, you have to be very specific. You have to say that this is what you're going to do. It might be obvious, but it's always good to be very specific.
Base currency, USD.
Very good. Yes. So you buy dollars from HSBC at 98.57, and then you sell the dollars to BNP at 98.58. Isn't it? Right. Now, the easiest way to identify is look at the highest bid. Okay, because bid means the price at which you're going to sell. No? If you want to sell something, you want to sell at the highest possible price, right? So in this case, the highest possible price is 98.58. And when you want to buy something, you will buy at the lowest possible price. Okay, so the lowest possible offer is 57. Isn't it? Which means you can now look at the quote. It's 98, 58, 57. So the bid is higher than the offer, which cannot be. It can't be the opposite. See, always the bid should be lower than the offer, right? Otherwise, there is arbitrage. Because if the bid is higher than the offer, you can always buy at 57 and sell at 58. You can keep doing it. Okay, so the bid should be lower than the offer. If the bid is higher than the offer, there is arbitrage opportunity. Understood? Any questions on that? Is that clear? Shall we try this? This is euro dollar. A is quoting 134.25.30. B is quoting 134.31.36. C is quoting 134.24.29. D is quoting 34.37. Right. So do you all see any arbitrage?
Buy UR from bank C and sell at D.
Buy euro from C and sell. Yes, very good, very good. Very good. Excellent. Right, so you can buy euro from C at 29 and sell it to D at 32. Again, if you look at the highest possible bid, it is 134.32. And the lowest possible offer is 29. So bid is higher than the offer. Definitely there is arbitrage. So you can keep buying euros from C and selling it to D. Then what if you buy euros from A and sell it to D? You can also buy euros from A and sell to D, isn't it? If you buy at 30, sell at 32. Or you can buy at 30, sell at 31. You can also buy at 29, sell at 31. So lots of arbitrage opportunities. Now to answer the question, where will you buy euros from? If you're buying euros, you will buy from which bank?
Lowest offer.
Yes, which is
C.
C. And you will sell euros to?
Highest bid.
Yes, which is?
D.
Very good. So you buy euros from C and sell to D. Okay. Any questions? Next one. These are US dollar LKR quotes. Have 4 banks. 130, 45, 50. 130, 43, 48. 44, 49.
Buy dollars from B and sell at D.
Yes, very good. So what's the highest possible bid? 130, 46. Lowest possible offer is, sorry. Lowest possible offer is 48. 130, 48. So you keep buying at the lowest possible offer. Buy dollars from B, sell dollars to D. Yeah, any questions? You keep buying dollars from B and sell dollars to D. Is there an arbitrage opportunity here? Do you see arbitrage opportunities?
No, sir.
Yes, there are no arbitrage opportunities. Okay, so any questions? So the next scenario. Let's say you have $1 and you have two options. One is to convert these dollars. Sorry, the first option is to invest this at let's say 1% for 1 year, right? 1 year. That means when it matures, how much will you get? If you invest $1 at 1% for 1 year, when it matures, how much will you get with interest?
$1.01.
Yeah, correct. It's 1 into 1 plus 1%, which is $1.01. Okay, so that is option 1. Then option 2. If the exchange rate is 200, and if the exchange rate is 200, you can convert this dollar into rupees. So you will get 200 rupees, right? 200 rupees today. And if you invest this 200 rupees, let's say again for 1 year, we'll assume at 10%. Right? Today the interest rates are a little opposite. You get dollars, might get 10%, but rupees you might get 1%. Right? But let's say these are normal circumstances. So if rupees you invested 10%, how much will you get when it matures?
220.
220, yeah. Okay. So there are two options, option 1 and option 2. Out of these options, which one will you prefer? Now let me put it this way. What exchange rate in 1 year, what 1 year exchange rate will make you indifferent between option 1 and option 2? What will make you indifferent? Option 1 and 2. It doesn't make a difference to you. What is the 1 year exchange rate which makes you indifferent to the two options? What should be the 1 year exchange rate which makes you indifferent between option 1 and option 2? How would you find it?
$270 rupee 270.
217. Okay. How did you get it? Right. Now in 1 year, you will get 220 rupees now. And $1.01. Right. So you divide 220 by 1.01. How much do you get? $2.17 82. $2.17 82. If the exchange rate in 1 year is 2.1782, whatever you do today will not make any difference. Right? Whether you invest $1 at 1%, or you convert the dollars today and invest the rupees at 10%, it doesn't make a difference if the exchange rate is 217.82 in 1 year. Right? So this is a theory which is called interest rate parity. Interest rate parity theory. That means for you to be indifferent between both the options, the 1 year exchange rate, the exchange rate in 1 year should be 217.82. Okay. So this theory is called interest rate parity. $217.82. Now, how do you get this $217.82? You derive it as 220 divided by 1.01. 220 is 200 into 1 plus 10%. And you can't see them. Yep. 200 is 200 into 1 plus 10%. 1.01 is 1 into 1 plus 1%. So if I segregate this, it is 200 over 1 times 1 plus 10% over 1 plus 1%. If you look at 200 by 1, it is 200, which is the exchange rate. So this is the spot rate. Into 1 plus, see, 1 plus the interest rate of the counter currency divided by 1 plus interest rate of the base currency. Yeah. So this 217.82 is called the 1 year forward rate. 1 year forward rate. So this is something you need to remember. Okay, so this is called interest rate parity. And this is how you calculate forward exchange rates. So when you request for a forward exchange rate from a treasury, this is what they will do. Clear? Any questions on this? No questions? Interest rate parity, the interest rate differential between two countries is equal to the differential between the forward exchange rate and the spot exchange rate. Interest rate parity plays an essential role in foreign exchange markets, connecting interest rates, spot exchange rate, and foreign exchange rates. An understanding of forward rates is fundamental to interest rate parity as it pertains to arbitrage. Forward contract is a contractual commitment to buy or sell a specified amount of foreign exchange for a specified price. It is called a forward exchange rate at a specified future date or maturity of contract. It's used to hedge or speculate in the future foreign exchange rate movements. The forward rate is not a guess as to what the spot rate will be on that future date. Now, that's a very important point. Because now, if we do a quick survey in this class, if I ask you what is your expectation of the exchange rate 1 year from today, what will you say? I'll just try a few of you all. Takshila, what do you think? No, Takshila. What is your expectation of the exchange rate 1 year from today?
It should be depreciate.
Give me a figure. Yeah.
A minute, please.
Until Takshila comes back, how about you, Dennis? What do you think?
Yeah, rupee will be depreciate.
Figure?
Do you need the figure?
Yeah.
It's 210.
210. Current exchange rate is 200. Let's say 200. So you feel 1 year it will be 210. You can see this. Yeah. Right. So that's what Dennis feels. Then Sampath.
208.
208. Yeah.
250.
You got 215.
250. Yes.
50. 250.
No, 215. That's correct.
Yeah. Okay. Ziad.
Depreciated by 210.
210. Okay. So you already have 210. Who else is in class?
මේ මම කඩේ යන වෙලාවට ගිහලා දාන්න චුට්ටක් ඉන්න මම ක්ලාස් එක ඉවරනකොට හැබැයි කඩේ ගිහින්
Right. So if there are 10 of you and each of you give me your expectations, we might get 10 different answers. Some might feel it will go, the exchange rate will go above 200, maybe 250, 210, whatever, right? Whereas some of you might feel it might come down, might come to 150. You never know. Like we didn't check with everyone. So some of you feel it might go up. Some might feel it might come down. But these are expectations. Right? Then those of you who feel that the exchange rate will go up might end up buying dollars. You prefer to buy dollars today. And those of you who feel the exchange rate will go down, maybe to 150, might feel like selling dollars today. So that is based on your expectation, your guess. Right? Whereas, what about this? 21782. Is that a guess? Is this a guess? Now, the 10 of you had 10 different views of the exchange rate now. But if the 10 of you do a forward exchange calculation, will you get 10 different answers?
No, it should be one answer.
Yeah, you'll get one answer. But as long as you use the same exchange rate and the same interest rates, you will get one answer. Right? So remember, a forward rate is not a guess. Then what is it? It is a mathematical computation based on the current exchange rates and current interest rates of the two currencies. In other words, it's called interest rate differentials with the two currencies, right? Now, interest rate differential. What is the interest rate differential between the two currencies? Rupee 10% and the dollar is 1%. So the interest rate differential is 9%, isn't it? Rate differential is 9%. Right. So what the shortcut is, roughly the exchange rate in 1 year should be 1 plus the interest rate differential. That is an approximation. So the spot rate is 200 into 1 plus interest rate differential 10% minus 1% is 9%. So this comes to 218. Okay, so that's a shortcut, but this is the technically correct way of doing it. Yeah, any questions? No questions? The forward rate depends on the spot exchange rate, interest rate on the borrowed currency, or forward receivable currency, and the interest rate on the lending currency, the forward deliverable currency. Okay, so the forward rate depends on these three factors: the spot rate and the two interest rates. The future value of the counter currency divided by the future value of the base currency. Yeah, so this is how we calculate a forward rate based on this equation, which we just derived. Right? It's spot rate 1 plus the rate of counter currency divided by 1 plus the interest rate of the base currency. Just look at the second point. An understanding of forward rates is fundamental to interest rate parity as it pertains to arbitrage, right? So based on these exchange rates and interest rates, the forward rate, 1 year forward rate should be 217 cents 82, right? So the difference between the forward rate and the spot rate, 217 cents 82 minus 200 is 17 rupees 82 cents. This is called the swap point. The swap points, forward rate minus the spot rate, 17 rupees 82 cents. Right. So the forward rate is also equal to the spot rate plus, based on this equation, forward rate is equal to the spot rate plus swap points. Clear? Understood? Any questions? No questions? No questions? Right. So let me pick your brains. Right. Just assume this exchange rate and these interest rates prevail. Now, what if the 1-year exchange rate in the market quoted by one bank is it has to be 207.82, but what if one bank is quoting 250 rupees? 1-year forward rate quoted by that particular bank is 250. Everything else is the same. What are your thoughts? If one particular bank is quoting a 1-year forward rate at 250, what are your thoughts? What will you do? First of all, what can you say about this? If one bank is quoted 250, whereas it should have quoted 217.82. What can you say about it? What might be there? How about a concept which we discussed about 5 minutes ago? Not 5 minutes, maybe half an hour ago. something called arbitrage. Do you see an arbitrage opportunity? Do you see an arbitrage opportunity? If you see an arbitrage opportunity, then how would you exploit it? Yeah. Is there arbitrage or no arbitrage? Did you understand the question? Is the question clear? Hello. Hello. Hello.
Sir, is that bank's interest rate expectations are same?
Yeah, everything is the same. Exchange rate, spot rate is 200 rupees. Dollar interest rate 1%. Rupee interest rate 10%. Everything is the same, but this bank is quoting 250 rupees.
Then they have a demand for dollars.
Okay. Yeah. Okay. Like maybe they have demand for dollars, but if you see this information, how will you make use of it, or how can you make use of it? For some reason, they are quoting 250. How can you make use of this information to make a profit?
So,
Yeah.
150 is 1 year forward.
1 year forward. Yeah, that
So-
particular bank is quoting 250 rupees as 1 year forward. What will you do? Yeah.
So we can buy from 217 for book forward 217 and sell them at 250.
Yes, correct. Right. You're right. You're right. Good. Good. Very good, Sam. Now, see the forward rate. That means spot rate into 1 plus 10% divided by 1 plus 1%. Right? Should have been 217.82. Correct? But this bank is quoting 250. The two sides of the equation, one side is more expensive. If that side is expensive, this side is cheap. You should always buy which side, the cheaper side or the expensive side? You should buy which side?
Cheaper side.
Yeah, you should buy the cheaper side. You buy this side and you sell this side. That means you sell 1 year forward at 250 rupees. Okay, so 1 year forward, you agree to sell at 250 rupees here. Okay, so let's say we just talk about $1. You agree to sell $1 at 250. Right? So to sell $1 there, today you need to buy dollars. Today you buy $1 at 200. Correct? Today you need to buy $1 at 200. So this 200 rupees, let's say you have borrowed at 10%. Right? Sorry, you need $1 after 1 year. No? So today you need the investment amount, because you need to end up with $1. You have agreed to sell $1 in 1 year from today. So your actual investment amount today should be $1 divided by 1.01, isn't it? If you, because you earn 1% interest, huh? You can invest this at 1% today. Sorry, I don't need 1 divided by 1.01, meaning $0.99 you invest today at 1%. Right? So you buy $0.99 today at 200 rupees. That is, you have to borrow 198.02 rupees at 10%. So you borrow 198.02 rupees at 10%. Yeah. Because why borrow? Because you don't have anything today. Right now, this is arbitrage. You go to a bank, you borrow $198.02 today. The bank will quote 10%, and that 198.02 you convert to dollars. Right, you end up with $0.99. Then this $0.99 you are investing for 1 year at 1%. After 1 year, you get $1. Right now, 198.02 you have borrowed at 10%. So that's after 1 year you have to pay interest of $217.82. Right, your loan amount in 1 year is $217.82. But you have agreed to sell this dollar at 250 rupees. So you are getting 250 rupees, and you have to pay your loan of 207.82. Right. So you'll be left with 32.18 rupees. That is your profit. 32.18 rupee profit. Did you all understand that? I'll explain once again. On this equation, the right hand side is heavier. So you agree to sell that side. You're selling, you agree to sell $1 1 year from today at a price of 250 rupees. Right? So 1 year from today, you're supposed to get 250 rupees from this bank. Now you have to give $1 to the bank now in 1 year. Okay, so what you do today is you buy dollars. Right? How much dollars do you buy? You can invest it at 1%, so you discount it back. You have to buy $0.99 today at an exchange rate of 200 rupees. Okay, so for you to buy $0.99 at a rate of 200 rupees, you need 198.02 rupees, which you are borrowing from the bank at a rate of 10%. After 1 year, you have your loan amount, 198.02 into 10% is 217.82. Right, so you have to settle this, but you have agreed to sell dollars at 250 rupees, and you will be left with 32.18 rupee profit. Is that clear? Clear?
Excuse me, sir.
Yeah.
Why did we consider $0.99 there at the beginning of the equation?
Yeah, because this is today now. This is today, right? And you are agreeing to sell dollars 1 year from today. This is today. This is 1 year. 1 year from today, you're going to sell $1, right? So 1 year from today, you have to end up with $1. Am I right? Or you can have done the other way around. You could have bought $1 today. Right? Could have bought $1 today, invested it at 1%, and 1 year from today, you can agree to sell $1.01 with the interest. You're agreeing to sell $1.01 with interest at 250. Both are the same. Huh? Here you get slightly higher profit. 1.01 into 250, 252.50 rupees, right? So to buy $1 today, you will need 200 rupees, which you can borrow at 10%, and you pay interest of 220. Okay, so you're getting in 1 year 252.5, and you need to pay 220 rupees of interest. So you'll end up with 32.5 profit arbitrage. Right? So depending on how much you're going to borrow today, you need to calculate how much dollars you will end up with, and when you convert this at 250 and settle your loan, you'll get the arbitrage profit. Clear? No?
Thank you, sir.
Understood? Yeah. Sean, you okay?
Yes, sir. Thank you.
Okay.
Yes, sir. Thank you very much.
All right. The others? Any questions? No? Okay, so what if this exchange rate is 1 year forward rate quoted by a bank is 200? What will you do now?
So we can buy from them and sell to another bank.
Buy from?
Buy from them and sell to another bank.
Yeah. How much profit will you make?
$17.8.
Okay. Right. If another bank is quoting 200 rupees as the 1 year forward, then the right hand side of the equation is lighter than the left hand side. Left hand is heavier. Then you can sell this side. Okay, you can sell dollars today. Let's work it out. Wait, 1 year forward, quoted at 200 rupees. You need to buy dollars, right? Because you buy the cheaper side, you have to buy this side, and you can sell this side. Now, when you sell, today you are selling $1. you will get 200 rupees, which you can invest for 1 year at 10%. You will get 220. Now you are selling dollars, which you may have borrowed. So you are selling $1, which you have borrowed at 1%. Okay, and 1 year from today, you have to settle it. You have to buy it back. So let's say with interest, you agree to buy $1.01. At 1 year forward, you agree to buy $1.01 at 200. For which you need 202 rupees. Okay. Now from this sale, you get 200 rupees, which you invested at 10%. You end up with 220. But to buy the dollars back to settle your loan, you need 202. So your profit is 220 minus 202. You end up with an 18 rupee profit. Arbitrage profit of 18. Okay. You understood or not? Does anyone have doubts? Okay. So if it's quoted at 200, you have to buy this because it is undervalued. You need to buy the forward and sell the spot. Buy forward, sell spot. You buy dollars forward and sell dollars spot. But if the forward rate is expensive, you need to sell dollars forward, buy dollars spot. Is that clear? Hello? So any questions? And if there are no questions, shall we take a break and come back? Yeah. Okay, sir. Just remember, for there to be no arbitrage, the interest rate parity theory should be satisfied. If it's not satisfied, you will get arbitrage opportunities. Okay. All right, so let's take a break and come back. It is now 3:30. It says what is the 1 month forward rate for dollar rupee given the following market rates. Spot rate given as 132.50. 1 month dollar interest rate 1%. 1 month rupee interest rate 6.3%. Trade date 18th and the spot date is 20th. Contract expires on 20th February. Number of days between the 20th Jan and February is 31. So you have been given spot rates and interest rates of the two currencies. So let's calculate the forward rate, 1 month forward rate. Okay, so let's write the equation. Spot rate into 1 plus the interest rate of the counter currency divided by 1 plus the rate of base currency. Spot rate given as $132.50. 1 plus the interest rate of counter currency 6.3%. 1 month. Divided by 1 plus the interest rate of the base currency 1%. $31,460. Take on basis given as 360. You get 133.09. Correct? Simple calculation. So what is the swap point? Is the forward minus spot minus 132.50, 59 cents. Right? 59 cents. Now, if you look at this forward rate, 133.09, it is higher than the spot rate of 132.50. Sorry, did all of you understand up there? Any questions? Do you have any questions? No questions, right? The forward rate 133.09, spot rate 132.50. Right? That means the exchange rate has gone up. So if the exchange rate has gone up, which currency has strengthened, the dollar or the rupee? Which currency has strengthened?
Dollar.
The dollar has strengthened. Right, dollar has strengthened. Then if you look at the exchange, the interest rates, look at the two interest rates. Dollar interest rate 1%, rupee interest rate 6.3%. Right? Dollar interest rate is low, rupee interest rate is high. And the currency that has depreciated is the dollar, the currency with the low interest rate. So that is what the forward rate gives. It says the currency with the low interest rate will appreciate in the forward. Right? The currency which has the low interest rate will appreciate in the forward. And the currency with the high interest rate will weaken. So the 1% interest rate or the dollar has appreciated. The 6.3% interest rate or the rupee has depreciated. Okay, currency with the low interest rate will appreciate, currency with the high interest rate will depreciate. Goes in the opposite direction. Meaning you can't have high interest rates and a strong currency as well, based on the forward exchange rate. Clear? So if the forward rate is higher than the spot rate, it means the base currency has strengthened. Right? You call it, you say the base currency is at a premium. Remember, the currency with the low interest rate will trade at a premium. Right? The forward rate of the currency with the low interest rate will trade at a premium. Will be at a premium. Okay. Forward rate of the currency with the low interest rate will be at a premium. Remember always, the currency with the low interest rate will be at a premium. It goes in the opposite direction. Clear? Any questions? If no questions, let's try the second example. Now, without doing any workings, can you all tell me? Sorry, let's go through the question. What is the 6-month forward FX rate for euro dollar given the following market rates? Spot rate 1 euro is 140.45. 6 months dollar interest rate 0.46 and the 6 months euro rate 1.45. What do you think? Which currency is at premium and which currency will be at a discount?
USD at a premium.
Euro will be at a
USD at a premium.
USD is at a premium because the dollar has the low interest rate and the currency with the low interest rate will be at a premium. So the currency with the high interest rate will be at a discount. Now in this example, the base currency has a high interest rate or a low interest rate. What is the base currency? My question is, huh?
Euro.
What is the base currency? Pardon?
Euros.
Yeah, euro is the base currency. My question is, will the forward rate be higher than the spot rate or lower than the spot rate?
The lowest.
Yeah, it will be lower. Why? The reason is euro has the high interest rate, so it will have to trade at a premium. Sorry, euro has the high interest rate, it will have to trade at a discount. If the euro is at a discount and it is the base currency, that means the forward rate should be less than the spot rate. Right? That is called a discount. Clear? So what do you get? Yeah. Counter currency is the dollar, 0.46. Base currency is the euro, 1.45. $1.3976. This is what you get. And the swap point, minus 0.0069. Correct? Do you get the same answer? So in other words, if you have a positive swap point, that means a swap premium it means the base currency has a lower interest rate than the counter currency. But if you have a negative swap premium or a swap discount, it means the base currency has a high interest rate than the counter currency. Do you all have any questions? Any questions?
Sir, how to calculate the offer and bid rate?
Bid and offer. The same concept. Right. Now, you have two rates, 1.4045 and maybe 50. Right. So you take the bid and multiply by the interest rate differential. In other words, the same equation. Okay. But only thing is, interest rates also there will be bid and offer. So you have to be a little careful. You will have to take the minimum possible numerator, maximum possible denominator for the bid. And when it comes to the offer, other way around, you take the maximum possible numerator, minimum possible denominator. Right. So I'm not going to confuse you, but you can still do it. Technically, there are bid and offers even for interest rates.
In this question, only one rate we can't do the both stated both. Right?
Come again?
With only one with the question asks both bid and offer, no? But only one rate has given, so we can't calculate.
Yeah. You can't calculate both. Only the bid. Only one rate. It's not given, but this is bid and offer. Okay. So only the forward rate. Okay.
Okay.
This is what we just discussed. Forward rates and interest rates. Base currency interest rate is lower than the quoted currency interest rate. If the base currency is lower, then the forward is at a premium. Forward will be higher than the spot. And if the base currency is higher than the spot, than the counter, the forward will be lower than the spot, or the base currency is at a discount. The difference between the forward rate and the spot rate is called the swap point. Right, what we just discussed. If the quoted currency interest rate is lower, right, or the base currency has a high interest rate, you will have a swap discount, and the forward rate will be lower. Okay, this is what we discussed. Same thing. Swap points are negative and the base currency is at a discount. If the quoted currency interest rate is higher, swap premium forward rate is higher and the swap points are sorry, it's not negative there, it has to be positive. Right, the second statement, the final statement, sorry, swap points are positive and the base currency is at a premium. Right, so if the base currency is at a premium, the swap point has to be positive. Just make the change, it has to be positive there, not negative. Okay. Again, what we discussed, the forward currency with a low interest rate will be at a premium, and forward currency with high interest rate will be at a discount. Right, so let's try these examples. I'll write it. I'll expand this and write 104.20 and 104.30. Swap is 30.40. So what is the forward? Right. So it has to be 31.04.20 and 41.04.30. Is it? Is this correct? What I wrote is correct?
No.
It's wrong. Why? Because if you look at this exchange rate, it has 4 decimals. If it has 4 decimals, the swap point has to be divided by 10,000. It's actually 30 divided by 10,000, which is 0.0030. And here it's 40 divided by 10,000, 0.0040. Now you add. $50,401, 1.0470. So that's how you get the forward rate. Right? You need to divide the swap point by 10,000. Next example. $yen. Spot rate 92.30.40. Swap 150, 130. Okay. And this example, they have already divided. Well, the exchange rate has 2 decimals, so you have to divide the swap point by 100. Here you have already been given after dividing. Okay. The swap point is 80, 93, and you will get 70, 93. Correct? Is this correct? Now, what's wrong with this? Can you see? Did you notice something wrong with it? Anything wrong with this exchange rate?
Bid is higher than the offer.
Very good. Bid is higher than the offer, right? So if that's the case, there is arbitrage because you can keep buying at 70 and sell it at 80. Which means there is something wrong. Okay, so let's go one step up. Look at the swap point. Sorry, the spot rate is 92, 30, 40, which is in order. Bid is lower than the offer. But what about the swap point? Bid is higher than the offer. Right? Bid in the swap point is higher than the offer, which is not a mistake. What it means is this swap point is negative. Right? So if swap points, you are given swap points and you have a higher bid than the offer, it means the swap point is negative. So it's not positive, you need to deduct. Okay.
Sir, this should be a stock points, no? Not stock price, right?
Sorry, the line wasn't clear. I couldn't hear you. Come again?
That should be square points, no? Not take.
Which one?
The question says.
Yeah.
The question says it says that swap rates, but should be swap points, no?
Yeah, swap points. Swap rate is fine. Okay.
Okay.
Yeah. Next one. $rupee. Swap points to 2.15. Forward rate will be 132.55 and 132.70. Okay. The first question: at what rate can you buy dollars 6 months forward? Buy dollars means you need to buy the base. The same principle, you will buy the base at the offer, so it will be 132.75. And at what rate can you sell dollars 6 months forward? 6 months forward, you will be selling the dollar. Dollar is the base currency, so you'll be selling the base currency at the bid 132.55. Right. So, any questions? No questions. Let's now try these examples. Euro dollar 133.2530. 6 months of 0.4560 at what rate can you buy 6 months euros? Amen. Spot is 45.60. Exchange rate has 4 decimals, so 45 you have to divide by 10,000. 45 and your price. What rate can you buy? 6 months euros. Euro is the base currency. You will buy the base currency at the offer. So this is the answer 133.80. Any questions? Question number 2. Spot dollar yen 98.2530. 6 months swap point 110.105. What rate can you buy 6 months yen? It says the bank charges a 5 pip margin. N is 98, 25, 30. Six-month swap point. $110,105. Exchange rate has 2 decimals, so this swap points you have to divide by 100. 1.10 and 1.05. So the 6-month forward dollar yen. Now the swap point bid is higher than the offer, so it is minus. And the bank charges a 5 pip margin. Like margin 0.005. These are the market rates. Bank charges a margin, right? So the margin will be reduced from the bid added to the offer, meaning the customer will get 5 cents less from the bid and he'll have to pay 5 cents more than the offer. Yes, okay. 97.30. What trade can you buy 6 months yen? You're buying yen means you'll be selling dollars. Right, selling dollars. Dollar is the base, so you'll sell the base and the bid. 97.10.
Excuse me, sir.
Yeah.
Could you explain why we deduct 0.5 pips from the bid and add 0.5 pips for?
Okay. Now, if the customer, right, if the customer sells dollars to the bank at 97.50, right, then the bank will make a zero profit because they will sell the dollars also at 97.50, right? But if the customer sells 5 pips lower, the bank will buy dollars something like this. It's something like this. Now, let's say let's take cargoes again. Again, the mango example. So let us say that Cargills is buying mangoes at 100 rupees. They're buying mangoes at 100 and they're selling mangoes at 110. Right? So they have 10 rupee profit. Now, if you are also buying mangoes from someone else, right? You don't have your own plantation, you are buying from a third party. If you are buying mangoes, and if you buy mangoes from the other farmer at 100 rupees, you'll be selling to Cargills also at 100, correct? Right? Do you make a profit? Yeah. You got the point? If you buy mangoes
Yes,
from the farmer at 100, and if you sell it to Cargills at 100, will you make a profit? Will you make a profit then? Yeah?
no.
You won't. Right? So you'll have to buy it. If you want to make a 10 rupee profit, if you want to make a 10 rupee profit, you'll have to buy it at price.
Lesser price.
Yeah, you'll have to buy at 9, then you make a 10 rupee profit by selling it to Cargills. Right? Clear? Then if you are buying mangoes from Cargills and you are selling to someone else, to another retailer, right? You want to make a 10 rupee profit, you will buy mangoes at 110. And what price will you sell?
120.
You'll have to sell at 120. Right? So if you want to make a 10 rupee profit either side, you will have to keep a 10 rupee margin from both sides of the market. Now, this is the market. Cargills is quoting the market. Right? You'll have to keep 10 rupees from either side. Isn't it? So likewise for the bank to make a 5 cents or 5 pip margin, they will have to keep 5 pips from either side. Right? From the bid, they'll have to reduce it and they'll have to add it to the offer like this. Reduce it from the bid, add it to the offer. Okay. So the bank will buy dollars at 97.10 from the customer and they will sell it in the market at 97.15. And on the other hand, they will buy dollars at 97.25 from the market and sell it to the customer at 97.30. Understood?
Yes, sir. Thank you.
Yeah. Any more questions? Third question. Spot dollar rupees 133.2530. And the 6 month swap point 270, 275. At what rate can you sell 6 months dollars? The bank charges a 5 cents margin. $270, $275. Exchange rate has 2 decimals, so you need to divide by 100. And the margin 5 cents. 5 cents minus from the bid, and you can add 5 cents to the offer. Okay, so any questions? Yeah.
Excuse me, sir.
Yes.
තුන්වෙනි එකේ මේක සර් මේ swap point එක එකතු කරේ අඩු කරන්න නෙමෙයිද තියෙන්නේ?
Third one.
ඔව්.
It is lower than the offer.
Okay, sir.
Yeah. Okay, so no further questions. Exchange rate regimes. There are two extremes when it comes to exchange rates. Right. One can be a completely free float. The other extreme is it can be pegged. Right. So exchange rates can either be at a complete free float or they can be pegged. Give me examples of free floating currencies. So these are two ends of the spectrum. Pegged or free float. Right. In between, there can be various combinations. So currencies might float to varying degrees. If you take currencies like the euro, sterling, yen, free float, nobody is controlling. But currencies like the Saudi Arabia, Arabian Riyal, Oman Riyal, Those are pegged to the US dollar. Right? Pegged to the US dollar. Then currencies like the Nepal currency. Nepal, it's either Nagultram or rupee. Right? It is pegged to the Indian rupee. Okay, so you can have a hybrid in between. Certain currencies are not free float, not pegged, they are somewhere in between. That is called a dirty float or a managed float. For example, the Sri Lankan rupee is not free float, it is not pegged, it floats, but the variation is managed by the central bank. Excess volatility is not tolerated. Right? Then the Singapore dollar, the Chinese yuan, they trade within a certain band. Okay. Yeah.
So is there a specific reason for certain currencies to be pegged?
Currencies to be
Pegged?
Yeah. Now, the Saudi Arabian Riyal, Saudi Riyal, Oman Riyal, the UAE Dirham, the Middle Eastern currencies basically, or the currencies of OPEC countries, right? Or the Gulf countries are usually pegged to the US dollar because now these Gulf countries export crude oil. Right? Crude oil is denominated in US dollars, right? So if the crude oil price changes against the US dollar, it gets reflected in the overall impact is the same, right? Because let's say for example, let's say crude oil is $50 a barrel, just assume, and let's say there is a Middle Eastern currency which is at say US to Saudi Arabian, let us just assume is at 3, it's 3.7 I think. Let's just assume it is at 3. Right. Now that means $1 is 3 Saudi Arabian Riyal. So how much is 1 crude oil barrel in Riyal? In Saudi Riyal? Yeah.
150.
Yes. Pardon? The crude oil, 1 barrel is $50. Then the exchange rate US dollar to Saudi Riyal is 3. Okay. So what is crude oil in Riyal? Crude oil in Riyal is how much?
$17. 17?
How much?
17 or something?
No. See, each dollar is three riyals. Like $1 is 3 riyals, right? You're forgetting the basics.
150.
150.
150 Saudi riyal. Right? Now, what if crude oil increases to $60 a barrel? US to Saudi riyal does not change, it is pegged. Right? It's still at 3. Then what happens to the price of crude oil in Saudi riyal?
180.
Goes to 180. Okay. So this is a 20% increase in the price of crude oil. What is the percentage change here? 150 to 180. $150 to $180 is what percentage?
40?
What?
40%?
My goodness, you are using a different calculator, I think.
20%.
It's just mine cal.
Huh?
20%.
It's again 20%. 20% increase. Right? So effectively, by pegging the real to the dollar, these Gulf countries are managing to enjoy the crude oil fluctuations. The fluctuation in crude oil prices, it's reflected in their own currency. Now, just assume that the dollar Saudi in this case was 3, and if it was floating, in this instance, if it had dropped to 2, then crude oil price in Saudi Arabia from 150 it will go to how much? If it is now at 2, if it's floating and if it went from 3 to 2,
120.
yeah, it will drop to 120. Right. If that happens, although crude oil prices has gone up by 20% in Saudi Riyal terms, they will experience a 20% drop, isn't it? That is because there is a 60% drop in the price of the Saudi Riyal. So, sorry, the price of the US dollar. The US dollar has weakened by 60%. So, if the crude oil price increases by 20%, it will get reflected as a 20% drop in Saudi Riyals. Okay, to avoid these kind of fluctuations, they have pegged it to the US dollar, and it's always at 3. It remains at 3. So, whatever happens to crude oil, whether it's plus or minus, things will not get complicated. If crude oil price goes up, that means in Saudi Riyals also, they will get more Saudi Riyals. But if crude oil price drop, in Saudi Riyals also, they will have an equivalent drop, right? So, it avoids complications. Clear?
Yes, sir.
Yeah. Good question. Any more questions? By the way, something I forgot. Going back a couple of slides into forward rates. Right, this forward rate. Remember, we did this calculation and we got 133.09. 1 month forward of 133.09, right? So let's assume you are an exporter. So if you are an exporter, you will get dollars. You will benefit if the exchange rate goes up or goes down. Goes?
Yes, sir.
Yeah, if the exchange rate goes up, you will benefit, right? So if the exchange rate goes from 100 rupees to 200 rupees, then you will get more rupees, so you benefit, right? But the risk is the exchange rate going down. From 200 rupees, if it drops to 180, then you will lose. Okay. In this case, the exchange spot rate 132.50. So currently it is 132.50. Today it is 132.50. And 1 month, when you get dollars in 1 month, if the rate goes up, you will profit. But if the rate goes down, you will lose. Okay. Now, if you book a forward exchange contract to sell dollars 1 month from today at 133.09. Sorry. Okay, if the dollar exchange rate goes down, you will lose now. Right? Now, so if you book a rate at 133.09, then what is the impact? You will gain or you will lose? Will you gain or will you lose? If you book at 133.09, what happens? You got the question? Today the rate is 132.50. You book a 1 month forward to sell dollars in 1 month at 133.09. You are expecting to receive dollars 1 month from today. Right? Now, when you do that, you will gain or will you lose?
You have gained.
You will gain. Okay, so you have booked a rate at 133.09. And the risk you earlier faced was if the exchange rate came down, you will lose now. So by booking this forward rate, you have eliminated the risk, correct? Right or wrong?
Right.
Yeah. Okay, so 1 month from today, on the 24th of August, if the exchange rate is 150, right? Exchange rate in 1 month is 150. Now, what is the situation? You will gain or will you lose?
Lose.
Then you will lose. Why?
You would have sold at 150.
Yeah, because you have agreed to sell at 133.09. Isn't it? You agree to sell 1 month forward today. Today you agreed to sell 1 month forward at 133.09. But in 1 month, the market is 150. So if the market is 150, you can now sell at what price? If the market is 150, you will be selling still at
133.
133.09. Right? Because that is a binding contract. Once you agree to the forward exchange rate, you have to stick to the rate. The rate will not change. Right? So you'll be selling at 133.09. But the market is 150. Now at this point, if you had not booked a forward exchange rate, you could have sold at
150.
150. But you booked, so you will be selling at 133.09, and you will be losing or gaining. You will lose or gain.
Gaining.
No, right? If you hadn't booked, you would be selling at 150, but now you are selling at 133.09. So you gain or lose. If you agree to the forward exchange rate, you will lose, because you have to sell at 133.09. If you had not entered into the forward exchange rate, you could have sold at 150. But now you end up selling 133.09. You lose. isn't it? Understood? But if the exchange rate 1 month from today is 100, then what happens? By entering into the forward exchange contract, you will gain or lose.
Lose?
No. Then you will gain. Why? Because the market is 100 now. But when you enter into the forward exchange rate, you are agreed to sell it. Remember, you are an exporter now. Yeah. Right. If you had not booked, you will be selling at 100. But you agreed to book, so you are selling at 133.09, which means you will gain, isn't it? Right. You are an exporter. You will get dollars here. You are expecting $1 million 1 month from today, right? And you agree to this forward exchange rate of 133.09. But 1 month today, from 1 month from today, if the spot rate is 150, you will lose. But if the spot rate is 100, you will then gain. Am I clear? Is that clear? Clear or not clear?
So, sir, entering into a forward the contract is beneficial if the dollar is appreciating, isn't it? And rupee is depreciating.
No, the other way around. You are an exporter or an importer?
Exporter?
You are an exporter, right?
Hmm.
So if the dollar is appreciating, that means if it's today 132.50, in 1 month's time it goes to 150, right? And you didn't have this forward exchange rate, you could have sold dollars at what rate?
150.
150. But you have entered into a forward exchange contract to sell dollars 1 month forward at 133.09. Okay. So whatever happens in the forward 1 month, whatever happens to the exchange rate 1 month from today, you will be selling dollars at 133.09. Okay. Meaning if the market goes to 150, you will. If the market goes to 150, you will.
Do at 150.
No, you can't. You'll have to do it 133.09.
133.9. Okay.
This one you have entered. So whatever happens to the market, you'll be doing at 133.09. Okay, so if the market is 150, you will do still at 133.09. You can't change exchange rate, the forward rate. Then you will lose again. You could have sold at 150, you are now selling at 133.
I lose.
You will lose. But if the market by any chance had fallen to 100, you are selling at 133, then you will
Gain.
gain. Okay. So you are an exporter, and if the market, you are an exporter and you book a forward exchange rate, you will lose if the market goes up. If the market goes above the forward rate, you will lose. But if the market comes down, if it ends up below the forward rate, you will gain. Isn't it?
No, sir, when an import happens, it's the other way around, isn't it?
Yes. Well, forget about currencies. Let's say you are going to sell your car, you agree to sell your car. Right. You agree to sell your car to a friend. He will buy it 1 month from today. You have agreed to sell it at 133. Right? Regardless of what the market is, 1 month from today, your friend is agreed to buy it 133. You are selling your car. But if the price 1 month from today is 150, you would have sold it at 150, now you are selling at 133. You will lose. But if the price has fallen to 100, then you will gain. Isn't it?
Yes, sir.
Anyone else didn't understand? Okay. So that means, have you eliminated exchange rate risk by entering into the forward rate? Have you entered into, have you eliminated foreign exchange risk by entering into a forward rate, a forward exchange contract?
Yes, sir.
You have eliminated. Okay. So if the exchange rate goes to 150, you will gain or lose? In this example, if the exchange rate goes to 150 and you have booked the forward rate 133, you will gain or lose?
Lose.
You will lose. So if you will lose, if there is a chance of losing, does it mean you have eliminated the risk?
Still you are getting a certain amount. Even though rate has gone up, you will still earn that certain.
Yeah. So my question is, you will lose, no? Right? If the rate goes to 150, you will lose, isn't it? Huh?
Yes.
Yeah. So by booking a forward rate of 133, have you eliminated the exchange rate risk?
Yes, you have eliminated.
Yeah. Then what if the rate goes to 1,000 rupees?
Risk to reduce the risk, we are booking the forwardness. So we have reduced the volatility.
Exactly. Yes. That point is correct. No, you have not reduced the market volatility. Right? And you have not eliminated the risk. Because if the exchange rate goes up, you will lose. Agreed? If the exchange rate goes up, you will lose. Yeah. So let's say you are competing with somebody else, right? You are in a competitive industry, maybe the tea sector or whatever, right? And you are in the export sector. There are so many other competitors. You are the only one who has booked. No one else has booked. They will make profits, or you will make profits, or everyone will make the same profit. They will make bigger profits, or you will make bigger profits.
They will make the profits.
Yeah, they will make profits. You will lose. You will go out of business. Imagine if this had gone to 1,000 rupees, and they will make thundering profits from the exchange rate fluctuation. You will make peanuts, isn't it?
Yes.
Yeah. Right. So you have not eliminated the risk. You are still exposed to the risk. But you have eliminated one risk. You have eliminated the price, the risk of price uncertainty. price risk has been eliminated. Because whatever happens to the exchange rate, you are guaranteed you will get 133.09. So price risk has been eliminated, but the exchange rate risk remains. The only thing you can eliminate is the price risk. You can't eliminate anything else. Clear? Exchange rate risk will remain. Just because you book a forward rate, you cannot eliminate exchange rate risk. Okay, so these are the kind of things you have to inform your customers that if you want, you can book a forward exchange rate, but it will not eliminate your exchange rate risk. Only thing it will eliminate is the price risk. Okay, because regardless of what happens, even if this goes to 1,000 or if it falls to 50, you're guaranteed of getting 133.09. That you can assure, but you can't assure anything else. So they'll make a profit or loss, you don't know. Clear? Any questions?
So, purpose of the booking the board is to make a certainty, not to earn profit or something like this. I understand.
No, it's actually, it has a direct impact on the bottom line.
Yes, it is.
It will directly affect your bottom line. Only risk you can eliminate is the price risk. Exchange rate risk is still there. Right? So your customer will know whatever happens to the exchange rate, he's guaranteed of getting 133.09. The only thing he has eliminated is the price risk. By eliminating price risk, he might be able to plan better. Maybe he might be able to do his budgets properly. He will know that in 1 month's time, or his cash flows properly. He will know that in 1 month's time, he's guaranteed of getting 133.09 into 1 million. Okay, 133 million rupees. That is guaranteed. So he can do his cash flows properly. Otherwise, if he does not know how much he's going to get in 1 month's time, then his budgeting and all that planning might be, he might have issues with his planning. Okay. So by eliminating the price risk, your client might be able to plan better for the future. But it doesn't mean his profit will increase. It doesn't mean he has eliminated foreign exchange risk. He's still exposed to it. Only thing he'll be able to plan better. Okay. And the thing will get worse if the tenor is long. This is only 1 month now. Imagine if he's booking for 1 year. If he's booking for 1 year forward, you don't know where the exchange rate is going to end up. Right? So he's taking a bigger risk. Only thing he'll eliminate is the price risk. Is that clear? Yeah? Any questions? Clear? If you all have doubts, you can always ask. You all understood? Can we move on? Ziad and Sapat, all right, under control?
Okay, sir.
Yeah.
Yes, sir.
Okay. Right. So let's move on. So sorry about that. We had to go back a few slides. Right, we want to exchange rate regimes. An exchange rate regime is the system that a country's monetary authority, generally the central bank, adopts to establish the exchange rate of its own currency against other currencies, right? So different central banks will have their own policies. Some will have a flexible exchange rate, others will have a very fixed pegged exchange rate. Each country is free to adopt the exchange rate regime that it considers optimal, and will do so using mostly monetary and sometimes even fiscal policies. Right? So sometimes they will use monetary policy or even fiscal policy to change the exchange rate. Right? So, for example, if a country goes on a money printing spree, that means sometimes the exchange rate can weaken, like what happened in Zimbabwe. Remember, on the first day we discussed Zimbabwe, 35 quadrillion. That is monetary policy. Fiscal policy, you impose more taxes, you're going to reduce the disposable income of your citizens. So you can use monetary policy as well as fiscal policy to manage your exchange rate. But it's very important that you don't have contradictory monetary policy and fiscal policy, right? If the monetary policy warrants the exchange rate to appreciate, meaning the local currency to appreciate, then your fiscal policy also should have monitor that, right? It should have that also in mind, that the monetary policy is trying to control the weakness of the exchange rate, right? So you can't have expansionary monetary policy and contractionally fiscal policy, or contradictory policies. They don't usually work. If you do that, then you're heading for disaster, and then there is no proper direction. So you can't have an expansionary monetary policy, whereas you have a contractionary fiscal policy, or contractionary monetary policy and an expansionary fiscal policy. Then it doesn't make sense. Right? So central banks and the government treasuries should work in sync, which usually happens. Right? They are always focused. The distinction among these exchange rate regimes is generally made between fixed and flexible exchange rate regimes. Right? So those are the two extremes. One is pegged, other one is flexible or floating. But there are many other regimes, some of which are in between these two extremes. There can be other regimes as well, like a managed float or a dirty float. Monetary union, shared currency such as the Eurozone, right? There are certain countries which share the same currency, like a monetary union. The EU is an example. All member nations have the same currencies. So if that happens, it means they are united from their monetary policy. The monetary policy is united, right? Each country will lose their independence over the monetary policy, okay? Because it's the union that decides for the entire region. You don't have monetary policy independence. You can't decide what to do with your country's monetary policy. So that's what went wrong with Greece. They could not print money. Printing money is part of monetary policy. You increase the money supply. Greece couldn't do it. So that's why they had to default. Then no separate legal tender. You use the currency of another country. Okay, it's like Zimbabwe using the South African rand or the US dollar. Because they had to abandon their own currency. There is no separate legal tender. You're using the currency of another country. Currency board, explicit agreements on a fixed rate between two or more currencies. Your currency is linked maybe to a couple of currencies. Target zone arrangement. Exchange rate is allowed to fluctuate within certain bands. Classic examples are the Chinese yuan, where the exchange rate is not supposed to strengthen or weaken by more than 5% or whatever within a day. Even the Singapore dollar is like that. And there is a zone. It is allowed to trade only within that band. Crawling peg, periodical adjust the exchange rate, right? So you have a peg, but the peg is adjusted. It's not fixed. Managed or a dirty float, flexible exchange rate regime with some government intervention. Dirty float or a managed float is where the government or the central bank intervenes quite often, and they don't allow market forces to always determine the exchange rate, but they manage it within certain parameters based on the direction of the economy. They might manage it. Right? So if the economy is getting lots of foreign currency, they might let the exchange rate float to a certain extent. But if there are other considerations to look at, they might try and control it a bit. Free float exchange rate is market determined. Right? Free float is the one extreme. The exchange rate is determined by the market. No one can interfere. The impossible trinity, also refers to as a trilemma, states that any exchange rate regime will only have two of the following three characteristics: free capital flow, fixed exchange rate, and sovereign monetary policy. Right? So you can't have these three. You can't control these three. Not possible at all. If you try to control all three, there is going to be a bubble somewhere and it will burst. Right? You're going to be in deep, deep trouble. Okay, those are the free capital flow, fixed exchange rate, and sovereign monetary policy. Right? So you can't control the capital that is going in and out of a country. Then you can't control the exchange rate as a free float and monetary policy. All three cannot be done together. You can only control maximum two out of the three elements. Okay, so one has to be always left out. Determine the most appropriate exchange rate regime for a country is not a simple task. Okay, because how would you know whether it's in the best interest of a country to have a completely floating exchange rate? You won't know. Right. Then how would you know whether it's best to have a fixed or a pegged exchange rate, like the Gulf regions? You won't know. The following figure shows the different regimes according to four different variables: exchange rate flexibility, loss of monetary policy independence, anti-inflation effect, and credibility of the exchange rate commitment. Right? So this shows the entire spectrum from one extreme to the other. Right? So monetary policy union is where you have absolutely no independence in terms of monetary policy. You lose monetary policy independence completely. Right? No separate legal tender. You depend on the monetary policy of another country. Currency boards, fixed exchange rate, target zones, and crawling peg. The beauty about having a target zone is that then it's very easy to control inflation. Right? Inflation is controlled based on monetary policy sometimes. Right? And the extreme is to have a clean float or a complete float, total float. Okay, so any questions? Mind you, your exam is not going to be very difficult, very, very easy. I'll make sure the questions are easy so that you all will get through. Just understand the basic concepts, fundamentals.
So what is the mean by anti-inflation effect?
It automatically controls the inflation. Right? You don't have to do anything extraordinary to control inflation, unlike a Zimbabwe central bank going on a money printing spree to control inflation. Right? Using the exchange rate, you can control inflation. Yeah. So now Chinese yuan, there is a target zone. So this target zone depends on, to a certain extent, on the inflation also. If the inflation is too high, they might reduce the target zone of the currency. But if inflation is less and there's more space, then they might increase the target zone, something like that. So it can, the exchange rate can be used in that circumstance to counter inflation. Yeah. Okay. Any more questions?
So when you have more managed or flexible rating scheme, is it difficult to control the inflation? Is it the case?
Flexible?
When you have a flexible exchange rate,
yeah,
rather than fixed exchange rate, is it easy to control the inflation?
Yeah, because then market forces will determine the exchange rate also. So automatically, everything, the system comes into a new equilibrium. Right? Every time the system is usually in an equilibrium. There can be shocks here and there, but usually the system is in equilibrium because it's market forces that determines the exchange rate. It's like now, you block a river and put a dam across it, right? That is something artificial. But the pressure from the river will decide whether the dam is going to break or whether it will hold. Something like that. If you try to control, do something artificial, then you're always interfering with something, and there can be bubbles forming here and there. But if you allow market forces to prevail, then chances are things will flow smoothly. Now, see, usually, sometimes you may have noticed that if there is no traffic police, traffic situation is less. But if a policeman or traffic lights start controlling it, then the traffic will worsen. Things like that. Right? So you try to artificially control something natural forces, you might upset the equilibrium. Yeah. Any questions?
Okay.
Yeah. As if there are no further questions, we will stop with this, and we'll meet next week. So thank you very much. Have a safe week. I will see you all next Saturday, same time.